Welcome to the Big Mike Fund Podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in. Because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fund Podcast. I'm the Big Mike.
Mike Zlotnik. Today, it is my pleasure and a privilege to welcome my good friend. Welcome back, Fuquan Bilal. Hi, Fuquan.
It's a pleasure to be back. What's going on, Big Mike?
Thank you, Fuquan. I appreciate you coming back. You hail from the, I'm not sure if you call New Jersey sunny. I guess sunny New Jersey, maybe cold New Jersey.
Cut it out. We're right across the bridge from you.
Yeah, but it's nice and cold, I guess. That's what New York has been. The weather has been weird this winter. I mean, every winter it's kind of weird. Not enough snow, feels too cold. I don't know, strange.
We definitely need more snow. I got to get out with snowboarding with my boys, so I need more snow.
Yeah, some folks. I don't know. We've seen a lot of cold, but not enough snow. But unless you go to like Boston area, we were at the ice skating competition. They always get snow. We don't get it here in New York, New Jersey as much. Anyway, what's new in the world of Fuquan? What's been going on? And how's family? How are your boys? You got two wonderful boys. They are active in sports. Just a couple of words about what's happening with the family, and then let's dive into business.
Yeah, family is good, man. I'm blessed, right? So I got two boys, as you remember. Talking about it forever. One is a young man, 21 years old, and the other is a young adult, 15 years old. So, going through fatherhood, that's, I think, the biggest challenge of my life, learning how to be the best father I can be, learning mistakes by raising them. So it's learning patience, which is important. It's a different patience with kids than with business, right? Tremendously different. But yeah, family is good. We're actually planning a trip to go to Egypt. This Easter, I believe. Yeah, this Easter, I believe, for the spring break.
That's awesome. Enjoy. That should be a fun trip.
Yeah, as far as business, what I can say is, as you know, we've been navigating the narrows, going through these turbulent times. Things are challenging on the raising capital forefront. Investors are still afraid sitting on the sideline. We have some investors with redemptions. You and I spoke about that a few weeks ago because they're just not educated and they don't understand what's happening in the marketplace, and they listen to the macro news instead of what's happening in the marketplaces sponsors are investing, right? I was actually talking to someone the other day and they were telling me that, rents are down, right? They saw something that said rents are down. And I'm like, I'm investing in making multifamily. It's booming, right? We're getting people who we don't even have enough turns that we can do to keep people from leasing up. So I think people should really understand what's happening on the local level instead of the macro level before they just take that general assumption of what's happening in the real estate market overall. That could be with fix and flips or multifamily. As we discussed last time, our fund has two verticals we're focusing on right now. One is fix and flips in New Jersey, where I've been investing for the last 24 years. The market is still strong. People are not lining up in size order like they did a year ago, to get properties, but things are not selling below list. We're still strong at list price. Instead of going on the contract, actually, I just listed one on the market last Saturday and it went on the contract yesterday. So, 30 days, 45 days the most. The longest I've seen, because I do a lot of high-end stuff, the longest I've seen something go on the contract was 65 days. And you're talking a $1.5 million house. So those tend to take a little longer than a small $400,000, $600,000 house. So that's kind of what we're seeing. I guess I got spoiled. A lot of us got spoiled with things moving fast with the wind in our backs. And now we're sucking up the wind. And trying to mitigate things. So that's it. I mean, the challenges are great because they make you think out of the box and become more creative. An example of that, Mike, is a multifamily deal we're doing in Macon. We looked at agency debt. We looked at long-term debt with HUD, which has the best rates. And we just wound up coming up with a strategic solution on assuming the mortgage and buying the LLC, right? So That way, all of the cost stays in place as if it never happened, taxes, insurance, things like that. So we had to become more creative because of where the market is at, right? So, go ahead, you have a question?
Let's dive into that. Before we do that, I'll just add a couple of comments to what you said, because you shared some really important wisdoms. And one wisdom was that every market is local. So when you hear something about something happening in Houston or Phoenix, that's not New Jersey. It's different, and every market is different. Very, very important to understand for folks in real estate that they have to understand it by market, operator by operator, strategy by strategy. It's all different. So you can't generalize. And we've seen the same story. People, because if you run an open-ended fund, this will add one comment. When folks are having problems somewhere else, and they can't get their liquidity somewhere else, or a problem with another project, where do they run? They run to an open-ended fund. They say, hey, give me a redemption because you have a redemption mechanism, other folks don't. So it's something to keep in mind that global environment or macro environment impacts us all, but folks' decisions should be made, obviously, based on individual investments. And whenever folks invest in real estate, may it be a fund or syndication or individual property, real estate is a long-term slow investment. So anytime people want to think of it, this is access to cash, that's not the place. Access to cash is in the bank, maybe infinite banking policy, whatnot. So something to keep in mind that when folks write a check into real estate, they got to have a long-term perspective through the cycles, because we're going through a cycle, no question about this. And then he obviously talked about prices, not residential real estate, not softening, but market timing, time to sell is increased. Obviously, we're dealing with a high interest rate environment, which has made it more difficult versus a couple of years ago. But let's go back to all the stuff you said is really, really good. But let's talk about creative finance. So I'm just curious, instead of getting a fresh Fannie Mae, Freddie, or HUD or any other debt, you're going with assumable. Assumable has all kinds of interesting benefits. But let's talk about the transaction. So
yeah, this one in particular is a 5.2% interest rate that's good for about 3 years, right? It's 6.2 something million in debt that's still on the property. The property is 98% occupied. There's only one vacant unit out of 142 units. It's a 8.2% cap rate.
And
so
where's the property? New Jersey?
It's in Macon, Georgia. Macon, Georgia.
In
All of our rentals we buy in the Southeast. We divested our rental portfolio in New Jersey.
Is this because of a
right after
better
COVID.
environment to evict, or is this just? I'm just curious why.
Well, better environment
you're
overall,
in New
right?
Jersey investing in Georgia. I'm just curious why.
Better environment overall, right? So, landlord friendly, number one, which is what you need, right? To evict faster. And
New Jersey is a tenant friendly state.
yeah, well, not only that, it's less expensive, right? New Jersey and New York, it snows all the time. You have that added expense for cleanup and everything else. There's a lot of opportunity for growth in those markets where rents haven't peaked yet. There's a big, huge opportunity, which is near and dear to me, for us to do our impact project. So, as you know, I come from a low income area, and part of the mission of our fund is providing quality housing. And our BHAG, our Big Hairy Audacious goal, is to provide quality housing quality affordable housing for low income families, 5,000 families to be exact. That's our BHAG. So, we're working on that, and to be able to serve that community is great. That's C plus B class areas, maybe 1974 to maybe 1985 build, somewhere around there, that house that type of community. And the best part about it is we get to mix the community with battered women and children, Section 8, behavioral health residents, to be in that community with, the cash paying tenants. So having that mixture is great because we can try to solve some of the affordable housing problem by keeping a percentage of those communities with that type of resident. And then the rest is fair game, right? We can raise rents to the roof, rubs and everything else. So that's our project, but that's why the Southeast, because we can do our impact project on a scale. Whereas New Jersey, we were doing smaller, 4 family, 6 family, and it takes a long time to scale up. And you have properties all over the place. And when it snows, you got to send a team out to shovel 150 properties. That may be 500 units for 150 different locations. So
Yeah.
geographically, it makes sense to do it in the Southeast to take down a 40-unit building, a 100-unit building, a 60-unit building. So that's kind of where we see the opportunity at, especially in markets where there's a lot of new developments coming, new businesses coming. Coca-Cola is putting $50 million. The mayor's cleaning up the city of homelessness. There's a lot of great things happening in Macon. So
Yeah, I appreciate that explanation. So the reason makes good sense. Obviously, you have a BHAG and a good mission to help folks with nice apartments, affordable, obviously the key word. So how do you, let's go back to the, I guess, subject to or assumable loan. So what are you buying the property for, and what the assumable loan is at?
it's a
In
$10
terms of
million
dollar
buy.
amounts, obviously it's a healthy rate, better than you can get today.
Absolutely. It's a $10 million buy, $6.2 million swingable mortgage. And we were looking at insurance costs, as you know, over the last couple of years, double, triple, right? So, went from 300 a door to 1,000 a door. It's just insane. Taxes,
How are you
everything.
dealing with this? Because this is an industry-wide problem. It's incredibly pain point, and it's a significant growth in expense per door per year. So that, and insurance companies are not likely rolling this stuff back. So your cash flows are going to suffer a lot. Your NOI is going to suffer a lot, and you don't have too many options. Many insurance companies pulled out. This is the terrible part. It's almost like a tidal wave that hit the entire industry. I don't know, insurance companies had losses or what, but what enabled them to do it? They just kind of all got together. It's like a cartel, like they
Yeah.
act like a cartel, like a drug cartel. Hey, we got to increase the price for the insurance altogether, and then they jacked it up. Some markets is like a double and triple. Some markets 30-40%.
Correct. So that is what makes you think out of the box when you're in a market like this. And purchasing the existing LLC that owns and operate the building allow you to do the transaction as if everything is still in place, right? Nothing changes with insurance, nothing changes with the vendors, unless you choose to get in there and start, getting better vendors or whatever. You're just stepping in the shoes of the current owner. But of course, you have to do diligence on the LLC you're purchasing and everything else. So that's
The
the
biggest
part
risk,
that
existing litigation, existing liabilities. You just got to make sure
correct.
that you're not buying cat in the bag with other problems, right?
Yeah, most of these are single member entities that the owns the building. It's not anything that is tied into it. So you have to make sure the members of that single member entity doesn't have any issues, and you just assign over the membership interest over to another entity. I mean, it's a simple process, but it's the due diligence behind the entity, which is, an arduous process. So you get the SEC attorneys involved, they'll do the due diligence and pretty much go from there.
So you're buying the PropCo LLC. So normally most of the deals are structured. You have investor entities and all that stuff above it, but you're not buying any of that. You're just buying the entity that owns the asset itself.
Correct. That's it.
Okay.
And everything stays in place.
Yeah, it makes sense. You don't have reassessment of taxes. As far as the world out there, they can't see that this entity, the owner changed hands. They can't. It's not obvious or transparent. So just a couple of questions. So when you take an assumable mortgage, does the bank underwrite you? You just go through a process where the bank has to review who is buying it, because it's assumable, right? So there's an underwriting process on that.
Correct. It's a full underwriting process, net worth, all that stuff, personal financial statement, everything. The same way as if you would go through an agency debt, but it's a quicker process because it's actually the building, right, that they're looking at. What is the building producing? Because it's not a personal guarantee loan, right? So
Yeah, it's a non-recourse. It's a lot easier for them. They still want certain characteristics of new owners, but
it's the building. They're just going to run any bankruptcy, just standard stuff. They run, through. So once you get all green to go on that, then you're good, right? It's just the logistics of the org charts and the operating agreements and how everything flows and What's the equity? Where is it coming from? All that diligence they do. And if it's like a CMBS loan, I think it's a CMBS loan, it takes a little bit longer, right? It has the defeasance clause and all the other stuff, it takes a little longer.
Yeah, understood. So let me ask you this question. When I think of the purchase subject to the existing loan, that's you're buying an asset. That loan is better than what you can get out there. So from that perspective, that's a good product. Now you're doing about 62% leverage. You're buying 10 million, the loan 6.2.
And by the way, the property appraised for 11.5.
That's wonderful, right? So from that perspective, of course, you're meeting the LTV requirement. Also, at that level of leverage, you should be able to meet that debt service coverage ratio without a problem either, especially if you have a loan from a few years ago. But the other question that I had is, are you getting really legitimately a good deal? Because the way I think of this is if you had to bring your own cash, you would have to borrow fresh money at a higher rate. You'd be looking for a better deal, or am I wrong? In other words, how do you get a really good deal and a assumable loan? Because basically it feels, okay, assumable loan, the deal has to be so-so. I mean, I just kind of thinking, being devil's advocate here.
Yeah, the deal is actually great because there's still a lot of meat in the bone. There were 20 down units, but they have them all up and running. They leased them all up at $950 a month, where the prior 2 bedrooms were at $750. So that gives us a target of where we can go. There's a lot of lease renewals coming up. There's still about 120 units that, as they lease renewal come, will turn, increase rents, and go from there. So, and housing just renewed their agreement with rents comparable to market rate. So all of those affordable home residents will go through housing, which captures market rent, which is amazing, right? So now you get to have affordable quality housing and capture market rent, which is a win-win. So there's still a substantial amount of units that need to adjust and also need to catch up with the RUBS. So I think the last time we checked, it was 70% of the total occupancy initiated with RUBS. So that's going to be a big revenue driver as well. And I mean, it's doing, I think, 110,000 a month in revenue. So it's amazing. It's a unicorn, actually, to be honest with you. It's rare that you'll see a great deal, as you say, in this marketplace that's occupied. And I believe the reason why is because of the relationship with the seller that we created. I purchased a prior unit from them a few years ago. And we closed actually the day we were in Manhattan doing an event for the Australian group, and we had just closed on that. And we had to eat dog food. That's where I got the term from you. He was like, "You got to eat dog food." We had to fund it ourselves.
Yeah.
So we did that, and we created a good relationship with the seller because we did what we say we was going to do. And this is the last deal they have, and we're going to be excited to close it. But I've looked at so many other deals, Mike, and I haven't really seen the opportunity that we need to make it a great deal. I've seen good deals, but not a great deal. So
How do you know what's a good deal, what's a great deal? And the reason I'm asking this is that, so we've seen very slow transaction volume. The last, 23 has been very slow. So everybody's concerned with the much high interest rates, what it has done to the market. But the bid and asks kind of widened and transactions not taking place. The sellers generally don't capitulate, especially situation like yours where they got a fixed rate mortgage. The mortgage is not maturing. The property's got good cash flows. And it feels like the seller doesn't have a big motivation to sell. Of course, you have your relationship with them. You're able to, maybe they have certain circumstances. Did they have other circumstances unrelated to the property that they had to sell? Because it's almost like this. If you don't have a motivated seller, why would they give you a nice discount? I mean, I see the situation.
He's tired. The seller's ready to cash out. He's owned 3,000 doors in Macon, and over the last 7 years, he's liquidated. And the last 2 I was actually able to get from him. He owns about 30 acres in Atlanta, where he has cabins, hiking, horseback riding, ATVs. That's his dream, right? Actually, when he closed on this deal, he's going to take his son hiking in I think it's the Appalachian Mountains or something. He said he's going to go away for 6 months. So he's, one of those type of guys that been there, done that, been around the block a few times, and just ready to hang it up. Played the multifamily game, did very well. Been in the business since the 70s, and is letting go.
Yeah, it's a retiring story. So there's other motivation. It's not to maximize every dollar, but okay. So I will acknowledge that's what you wanted to hear. You wanted to hear property doing good, motivation from the seller from something else. It's either seller divorce, death in the family, or ready to retire or some life event, which is it sounds absolutely like a potentially really good driver for the seller to just tell motivation to exit, and then you're able to pick up a decent deal. By the way, interestingly enough, depending on the article, some folks talk about these properties that are not in deep distress, but they are actually decent and performing. Just got to find seller motivation. Seller motivations obviously varied. One of the biggest motivation that kind of exists out there today, if the property is good, but the asset itself borrowed floating rate debt, and then they're dealing with the mortgage reset. The other story I've seen, perfectly good assets. I'm not sure if it becomes an opportunity too, where the seller doesn't have a big motivation other than they have a maturity cliff. They borrowed 5 years ago.
Yeah.
The loan is maturing, or the loan is just and today you just can't. It's a 4% loan that has to renew at 7%. It's just the financial motivation, not the asset motivation.
Yeah, we've been seeing a lot of the floating rate scenario where they're just getting choked and it's not any cash flow at all. They're putting in money to make the deal work to pay the bank, and they're just. I mean, I've seen the deal come out at 90 a door to 70 a door to just recently the guy was like, we'll take 63. And I'm like, this is the 55 a door deal. What do you mean? He's like, come on. You sent me an LOI 2 months ago for 61 a door. And I go, that was 2 months ago. It's different now. It's 55 a door. Let me know.
Is the market correcting right now?
It's Columbus. It's Columbus. But I don't have the capacity to do the deal. I'm just pushing them to see where I can get them at, to see if they're going to jump, because no one else is interested. I'm going, why is no one else interested in this property, right? I mean, we didn't do the boots on the ground due diligence. We just underwrote it, and we came out at, this is 61 a deal, but maybe when we get out there and start due diligence, it may be something else. It has the occupancy is only 78% occupancy, and we've really been trying to focus on great deals, getting back to that. To me, a great deal is something that is 90% or more occupied, that has great opportunity for us to do some CapEx to increase the value of the property. And if we can't find that, then it's like, what's the use, right? Because we don't want to get temporary financing. We want to get bridge debt.
So at this point, you're avoiding bridge debt. You would rather have permanent financing,
unless they're going to do owner financing for a term, right? So if I can find something that is less than 90% and there's some owner financing involved with a fixed rate, then it's a great deal.
Right? Because bridge debt is a lot more expensive. Bridge debt is tied to SOFR plus an offset versus
correct.
Yeah.
So owner financing at 6.5%. Yeah, owner financing at 6.5%. I'll buy a cost. I'll give them a price because they're giving me terms. We'll buy on terms. The Eddie Speedway. We'll do it that way. We'll meet them where they are because they're essentially becoming an investor. And that gives us time. It has to be a minimum of 3 years with that same rate, interest only, to give us time to go in and do what we need to do, increase the occupancy, and take them out with the HUD loan or, Fannie Freddie, some agency debt. And it's a great deal if you can do that, right? But a lot of sellers need the money, especially if they have the situation where the floating debt is choking them. They just need to sell it, get rid of it.
Yeah, and I appreciate your wisdom here. Very interesting perspective. I didn't expect, if you're getting a good deal, you got to be prepared to borrow some bridge debt and deal with renovations. And this is a standard practice. A few years ago, you borrow bridge, and that was the normal procedure because the interest rates were low. Now the interest rates are high, so the bridge debt is very painful and expensive, and that's why you're trying to avoid this bridge. It's not the bridge debt by itself; it's the rates that are available in that sector. And that's why you need the occupancy to be high up there to be able to get some kind of permanent financing. Otherwise, the property wouldn't qualify.
Absolutely. Or you just can assume the loan and put the seller in a prep situation and give them some interest, let them eat, make some passive income while you're executing your plan, and you just raise, the rest for your capex, and you go from there.
So Fuquan, I love it. This is it's an important, let's just call it investment thesis. Like for this year, we're all developing investment thesis. A lot of what we're doing today, we are launching a fund focused on providing mass debt, rescue capital in some of these challenging situations. It's a thesis, right? We know these problem situations. Your buy box, your buy thesis, your ideal scenario is you want to avoid those situations where you got to go borrow floating rate debt and stick. It's a very valid philosophy. It's a different buy box, and the stuff that doesn't fit that buy box, you're just gonna pass because it's not for you. For somebody else, it may be. So it's kind of interesting, but we do see there's a lot of deals in the 75, 80, 85% occupancy. They do need further property improvement, leasing, some renovations, and they can do well because they have a lot of units to lease up, right? They have the NOI is weak because of the current economics, but it's not that you want to be dealing with. You want to be dealing with more or less stabilized properties with the upside on the rent side and agency debt. It's a very different. I actually appreciate this because it's a different perspective than some of the other folks, which is
I mean, this market has you think
a more
outside the
conservative
box.
approach, I would say.
Yeah, this market gets you to think outside the box. It's always, as a sponsor, you're thinking of what's the safest way that I could navigate this deal to protect the investors. I mean, we were at a conference a few weeks ago where they did the diagram and they did the center, the outer box, and the outer box, and they talk about, when you're looking at a deal, what are you looking at to make sure that you could do this deal? First of all, it's good. It's the deal, then it's the investor, then it's you last as the sponsor. Remember that. So when you're looking at a deal, you're looking at it from that view. And even with investors, right? What I'm seeing is that some investors are still drunk off yield. They're still chasing who has the highest prep, right? Who has this, who has that, right? Well, it's two sides. Is a debt market is not equity. So even in the debt market, if they go into a debt fund or whatever, they're looking at, okay, is there liquidity? What's the highest rate? What's the term, right? And I want to go on liquidity, highest rate, short term. But what they fail to realize, and we've had these conversations before, when it comes to liquidity is only good when you have it, right? So if someone wants to put in for redemption and you have to trigger to sell an asset to get that liquidity, they have to wait. And some people don't understand it. Even though it's written in the PPM, they don't understand that. So those are some challenges that some sponsors are having in this marketplace also. So we always like to try to forecast and look ahead and make a pivot before things happen. And one of the things that we're doing actually is we're changing the structure of our investment vehicle where we're just going to go to, instead of multiple classes, one class. We're going to turn off the faucet on these different classes we have, turn on a new faucet of maybe a 10% or whatever it is, right? And basically give a longer term, because we're gearing up for those great opportunities, and we need to have the money for a longer period of time, right? So we're only looking for investors. We're looking to align ourselves with our long-term vision, not what they're going to get out of it for short term. Now, I understand everybody has different dynamics in their portfolio. They may have lost money over here and there, but we're setting ourselves up for success for what's to come, right? So maybe interest rates go down. It gives us the fix and flip market is booming more than what it is here in North Jersey. We have more opportunity to buy, or we find a multifamily deal where we need the money for a longer term period hold. So we're just being mindful of that and just trying to attract the investor that fits into that box, that believe in our vision, part of the mission, and they have a long-term vision to invest.
Yeah, I agree with you 100%. Just had another call in the same conversation that you don't want to take all money. You just want to take the right money with from right investors, that you are right for them and they're right for you. And they have to be very good alignment between what you're trying to accomplish and what investors expect. Because if they expect to get out in 2 years and you're trying to buy an asset for a 5-year timeline, it's a misalignment. And many folks, again, like we talked, they don't understand. They think you had a redemption clause after 2 years. They think they just press the button and hit. It's not a sell. Stock on a liquid market. Real estate is not liquid, and if you have to sell in a wrong market, it's a mission impossible. So yeah, I agree with you. And not only that, it's also philosophical, understanding what people want, what they expect. They want passive income, but they don't need immediate ability to exit. And all these issues, by the way, they surface. It's kind of funny how it works. When the markets are stable for a long period of time, things work really well. And markets got shocked. I mean, they got shocked and destabilized with the COVID, which was a black swan event. Then helicopter money, the government obviously keeping the economy rolling and throwing way too much money into the system. They overdid it. They caused massive inflation. And then this inflation forced the Fed to wake up, and they just sort of went very aggressive. And as a result, they shocked the system. So when the system shock happens, a lot of things change fast, and investors, including, they're adjusting to what's just happened. And then what used to work, again, normal redemption process, subscription redemption, exits, all worked because there were never these shock events. So the systems break when they're designed for long-term hold, steady, predictable, and then suddenly they're now dealing with a shock, and that's kind of what has transpired. So I appreciate you adjusting your fund to be able to align with what you need to do your business right versus what investors think they want, because then there's a mismatch. So I'm totally on board with that philosophy, and I applaud you for doing it, because you definitely want to get people who work with you and you work with them. Not some money comes with strings and you don't want those strings. So
Yeah, we don't want people who's drunk off yield.
yeah, and then the whole drunk off yield conversation is a dangerous discussion. But of course, high interest rates environment for some folks who, if you're lending money,
it's a lender market,
you
of
welcome
course.
that.
Of course, if you have the resources and the wherewithal to, be a private lender and, lend money out and earn 16%, 15%, take advantage of it. It's just understanding it though is important. Like, what do you have to do for that? What's the risk involved with that? But for us, we're thinking long term, right? We're not just thinking what's happening now. I mean, we're thinking 10 years out. What do we want in 10 years? What's our VHAG? Okay. What do we need to do in 7 years to get there? 5 years, 3 years, 1 year, this quarter, this week? What do we need to do? Right. So that's kind of how we look at it. And some of the things we need in order to achieve those goals are capital for long term. So if we can attract those investors who understand our track record and our core values and align with our mission, we believe we will be successful in achieving it.
Yeah, I appreciate that. It's hard for one. It's hard for all of us in this environment. People don't want to hear, okay, I'm parking my money for the long term. It's almost
I get it. I get it.
In this environment,
Hey,
folks are
it's
comfortable with keeping the money in the bank and get their 5.5%, and don't stress it.
hey, I'm an investor also, right? And I'm just not invested into one thing. I may have some short-term stuff. I get it. I may have some long-term stuff. I have a mixture of it because I have a long-term mindset. And if I know there's a good operator and a person who's going to stand tall when things go wrong and communicate and make it right, I don't have a problem investing with that person for 3 to 5 years.
Well, it's your diversified portfolio.
Yeah,
with
absolutely.
enough cash, enough short duration assets, as well as long term. And it's exactly, if you follow a portfolio composition theory, folks should do exactly that. So
Yeah,
it's just kind of the last few years where the changes that have taken place has sort of shocked folks, and then the normal behavior, the long-term behavior, has been both psychologically and physically adjusted, sort of impacted, in a manner of speaking. So let's continue. Any other interesting developments? Obviously, you're changing your fund, NNG. You found a great asset in Georgia, and What else? Just any other quick updates?
We got a lot of exciting things going on with the fix and flip. So in New Jersey, we still do fix and flips. A lot of exciting things. I'm so glad that I'm a part of Collective Genius and I get to pull the wisdom from people who are so further advanced than me, and just all the tools, the resources, the processes. We made a pivot 2 years ago to start to go more into high end. And I love it because New Jersey, as you know, there's a lot of money in New Jersey, and a $1.5 million house is nothing for a New Yorker who's coming over to buy a $1.5 million house. That's a 2-bedroom apartment in Brooklyn. So, so that's been great because we get to set ourselves apart from the guys who are just going and just doing retrofit, taking out the kitchen cabinets, putting new, taking out the vanities, changing the light fixtures without either, gutting the thing out and doing a fresh full renovation. So our gut rehab projects has been going very well, bringing quality projects to the market also on a luxury level, giving those buyers something that stands apart from the market because New Jersey has a 10-year homeowner warranty, right? So they buy a ground up construction, the builder has to provide them a 10-year warranty. So that's really what's setting us apart from the market, that a buyer know I could buy something, if something goes wrong within the next 10 years, or mechanical or foundation or roofing, I can get it fixed. So we've been getting a lot of buyers putting things under contract quickly because of that, right? So we're excited about that. I mean, those two verticals alone, the multifamily rentals and the fix and flips, are really good for us because it gives us that diversified structure to create a buffer and hedge against any market uncertainty. So we're not bulletproof, but as the harder the market gets, the more it have us become creative and think out the box. So I love it.
Yeah, I appreciate it. So the pivot to a little bit nicer properties. Did you have to change the market? I assume you have to change the markets where you work. So you moved probably from a little bit less expensive areas.
Yeah, from the low income areas. So we were doing everything primarily in the low income areas, the fix and flips and the rentals, all in the same geographical area, low income areas. So after COVID, those areas became super expensive and the profit margins decreased like immediately because it was a massive amount of people buying stuff, which drove prices 30% over list price, and construction costs was up with materials. It was a whole bunch of different dynamics. And I'm looking at it and going, we have capital to compete with builders in A-class areas, right? We have the capital to do it, right? So why aren't we doing it, right? We were so stuck on, we want to do our impact project. Everything we want to do is going to be in a low income area, rentals and the buy and rehabs. So that way we are steadfast in our mission, developing this community with every and anything we touch. Then I had to look at it and go, we still can create our impact. It doesn't have to be in New Jersey. Let's take that to the Southeast where we can do it on a bigger scale. And let's also bring up the fix and flips, the buy and fix and sell product to a higher market, right? So we can make more profit, do new construction, which is more predictable cost. And in the Southeast, do our impact project where we can continue our mission. So it took us about a year to kind of get the logistics and get it off the ground. But, we have the processes, our SOPs to tighten all that stuff up. And I appreciate the slowness, right? After third quarter of 2022, things got real slow for a very long time. And that gave us time to create operational efficiency, go deeper. We did liquidated one fund, focused on one fund at one time, so we can go deep instead of wide. So now today we just have one vehicle, and it's just a great thing. One vehicle to do K1s from and 1099s and everything else.
You're telling me?
It's beautiful.
We're on a family of funds. I know how painful it is.
It's beautiful.
Yeah, if you can get everyone into a single.
It was a lot of work. I had to call.
But it took courage. I'm sure it took courage to make the change.
Yeah, I mean, because you get used to it, right? And perception is everything. So that makes the mindset. So I had to tell myself, this is going to work, and here's why it's going to work, and here's why it's going to be beneficial for every investor in the fund. And I just picked up the phone, call myself, and start making these calls. And I may have I'll say 200 investors. I may have had 1 or 2 people go, no, I want my money back. No problem, here you go. nice knowing you. So it happens, but I'm so glad that we made that pivot because now we can go deep instead of wide, create operational efficiency. And I believe as we go through, we made that change second quarter of last year. I believe once we get to bottom of third quarter this year, everything will be much more organized, and then we can start to get that traction that we need. So I'm excited about it.
Yeah, I appreciate that explanation. And again, applaud your courage to make the change, and certainly going to a bigger dollar amount creates, makes your life a lot easier, and obviously a different community. And sounds like you pivoted to a lot more of ground up versus, I guess, fix and flips.
Correct. Yeah.
Yeah, makes sense. All right. All good things must come to an end, unfortunately. So does this episode. Appreciate you. What's the best way for folks to reach out to you? What's the website?
It's been a plum-pleasing pleasure. I always appreciate, talking to you, Mike. And if anyone wants to reach us, you can go to nngcapitalfund.com, nngcapitalfund.com. Check out what we have there. You can schedule a call to speak to me and learn more about what we do.
Thank you, Fuquan. Appreciate your wisdom, your sharing, your pivot, and we'll continue the discussions and the journey together. So in many aspects. So it's great to be many masterminds with you, and enjoy cold New Jersey. I guess. Or sunny New Jersey, whatever you want to call it.
Awesome. Have a great day, man.
You too.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike's Zlotnick. Keep listening and keep investing Big Mike style. See you on the next episode.